Hello and welcome back. In this lecture video, I'll be talking about how to actually calculate net present value and also internal rate of return. All right, so where we left off is we classified our cash flows as inflows or outflows, and then what we also looked at is we had our required rate of return. So returning to this example of Harper Company, if we say given the above data, should the contract be accepted? Now, the reason that we have to use net present value in this situation is because if we look at this, if we look back over here at this problem, we can see Harper Company's been offered a 5-year contract to provide component parts. And here's the data. The thing is this lasts over 5 years. The costs of the special equipment would be now. We have to reline the equipment. We said that was a cash outflow. In 3 years from now, we're going to sell it in 5 years. And then what we also have is we have our annual sales revenue and expenses, okay? The thing is the reason that we have to use net present values because we're having these costs and revenues occur at different points in time. So if we just simply went through and added up all, took all the revenues and subtract all the expenses, those are occurring at different points in time. So you wouldn't really be comparing apples to apples, and you wouldn't be considering the time value of money. So that's why we want to use a net present value approach to solve this problem, because the net present value approach does consider the time value of money, and it considers that we have these cash inflows and cash outflows that are occurring at different points in time. And so what we need to do is put them all in today's dollars so that we can compare the present value of our cash outflows to the present value of our cash inflows. So when we look at this, we say, should the contract be accepted? And that's what we're going to try to do. That's what we're going to try to solve right now. So what we have is we have our sales revenue of $750 up above. We have our cost of our parts sold, and then we have our shipping costs at $270. And so what we can do, we can take our revenue minus our costs, and what this is going to give us is our $80,000, which is our annual net cash inflows. We take our cash inflows minus our cash outflows on a yearly basis, and we get $80,000, okay? Then what we can do to solve net present value problems is we can set up a table to help us solve these. And the table that you see that we have right over here is I have the period or the year, and then I have the actual dollar amount of the cash flow, then I have the factor, and then that equals my present value. So when I set it up as a table like this, it makes it really easy to solve because all I have to do is multiply the cash flow times my present value factor, and then I get my present value. So when I have my investment in my equipment, when does that occur? It occurs now. So year 0. They're investing in the equipment now. That's why it's year 0. If you look back on their prior page, the cash flow was $160,000, and I'm just going to represent that as a negative to show you that it's a cash outflow. You don't have to do that, but sometimes it just makes it easier to keep track of things if you just say, all right, I'm going to put the cash outflows in parentheses. Now, because it's right now, the present value factor is 1, because it's now. So there is no discounting, okay? So I take my 160,000 times the 1. That gives me the present value is 160. Then I can look at my annual net cash inflows, and that's what we calculated right up here. Now, when does that occur? If you looked on the prior page, right, it said it was a 5-year contract. So it occurs in years 1 through 5. What is the cash outflow? It's $80,000. Now, the real trick comes in right here, where we have to determine whether or not this is an annuity or a single amount. And so remember, the difference is the present value of a single amount is that we just have some single amount. So for example, maybe what we do is we have invested in, we've just shelled out some money. Maybe the relining, if I look back at the other example, the relining of that equipment, that's a single amount because it's just a one-time cash flow. The difference is that this occurs every year, years 1 through 5, and it occurs every year, and it's the same dollar amount, equally spaced out. And what I mean by that equally spaced out is it occurs every year. It could occur every 6 months, every month. Those are still all equally spaced out, and that's fine. But in this case, it's just every year, but it is the same dollar amount every year, which means it's an annuity. That's important because we need to know which table to use to look up our factor. Because this is an annuity, we wouldn't look in the present value of a single amount table. We would look in the present value of an annuity table, which in your textbook is Appendix B. Okay, so if you look in Appendix B, and I'm going to show this here in 1 second, okay, we look in the present value of an annuity table, and that's going to be, if I look over here, and give me a second, I just have to adjust this, okay, and what I'm going to do, it's the present value of an annuity table, table B.3, and what I'll do is I'm going to look up 10%, because this is my required rate of return. So I have my 10% right over here, and then how many periods do I look up? I look up 5. Why 5? Because it's a 5-year contract, and those cash flows, those annual net cash inflows are occurring from years 1 through 5. So I look at period 5, and I look over, and then what you can see is I have 3.7908, and hopefully you're following along with me in the book, 3.7908, and that's 10%. That's at 10%. So that is my annuity factor. So we looked up our annuity factor is 3.7908, and that was from the present value of our annuity. And so when I multiply my 80,000 times my 3.7908, I get a present value of 303,264. Okay. The relining of the equipment, that occurred in year 3, if you're following along in the course back. And then the actual dollar amount, remember that was a cash outflow, so I'll express that in parentheses. Now that relining of the equipment is a single amount. It's not an annuity. It's not multiple cash flows, multiple equal cash flows that are equally spaced out. It's not an annuity. It's a single amount. So what you would do is look in the present value of a single amount table. So here's my present value of a single amount table. It's table B.1 in your textbook, and I'll be looking up 10%, which is my required rate of return, and then I look up 3 years. Why 3 years and not 5 years? It's because the relining of the equipment occurs in year 3. So here's my factor, 0.7513. So I can multiply that times 0.7513. That 30,000 times that gives me my 22,539. The salvage value of my equipment, remember that occurred in year 5, and it was $5,000, and it was a cash inflow, so I'm not going to put it in parentheses. And then I'll let you look up this factor and put it in. So take a second and look up the factor. And when you look up the factor, remember you had to look in the present value of a single amount, not the present value of an annuity, because it's just a single amount. You would get 10%, period 5, 6209. And then what I can do is multiply my 5,000 times my 0.6209, gives me 3,104.5. Now I can calculate my net present value. What I can do is take my 303,264 plus my 3105, and then I could subtract my 160 in my 22,539, or I could treat these as negative numbers and add them. It doesn't really matter. What you need to do is take the present value of your cash inflows and subtract the present value of your cash outflows. Okay? And when you do that, you get 123,829.5. That is my net present value. Now, should we take the investment? Yes, we should, because we have a positive net present value. Okay? We should take the investment because we have a positive net present value. Now, I just want to comment that simply because we have that's what we're dealing with in this class. That's our rule to say, yes, we have a positive net present value, take the investment. In the real world, it can be a little bit more complex because you could have multiple projects. One project may actually have a net present value of $150,000. Well, in that case, that's the one that you should take. But what we're saying in this situation is Harper doesn't have any other alternatives that we know of. So it's either they take this one or they don't, or they do nothing. In this case, they should take this. Another way to look at this is to say the present value of the benefits of the contract exceed the present value of the costs of the contract. Okay, that's another way to look at that. So what I'm going to do is I'm going to pause the lecture video, and what I want you to do is I want you to do this problem, this additional net present value problem, okay, and I want you to do this net present value problem on page 280 of your course back, and then we'll come back and we'll check it together. Okay. Okay, so let's check to see how you did. So what we have is our first example problem. An investment costs $50,000, returns $22,000 per year for 5 years. Determine the net present value if the required rate of return is 14%. So we set up our table just like what we did before. We have our investment cost. The year is 0 because that's when we pay for it. It's a cash outflow, so we put it in parentheses to show it's negative. The factor is 1. Gives us the present value of negative $50,000. Or it's $50,000, I'm just putting it in parentheses to show it's a cash outflow. Okay. We have our return, which lasts through the $22,000, years 1 through 5, 22. And then I look up my factor, and what I have is I look in my present value of an annuity table where the number of periods equals 5 and the rate of return equals 14%. This is my factor, 3.4331. 22,000 times my factor gives me my 75,528.2, and then I take my cash inflow minus my cash outflow gives me net present value of 25,528. Should we take the investment simply based upon this? Yes, we should. We'll look at the next one over here. Our company is interested in acquiring a new machine that costs $92,000. The machine lasts 6 years and provides cost savings of $23,000 a year. A required rate of return is 12%. Compute the net present value. So again, to solve this problem, we always set up a table. It just helps so much. We have our investment that occurs in year 0. $92,000 is the cost savings. Our factor is 1 because it's now. $92,000 cash outflow is our present value. We have our cost savings, which we treat as a cash inflow. Cost savings are cash inflows. That lasts from years 1 through 6, $23,000. And then when I look up my factor in my present value of an annuity table, where the interest rate equals 12%, and the number of periods equals 6, I get 4.114. The 23,000 times the 4.114 gives me my 94,562. I take my 94,562 minus my $92,000, I get $2,562 as my net present value of cash inflows minus present value of cash outflows. Again, don't get confused thinking I take 94,562 minus a negative, which would then of course be a plus, plus. People have said that to me in the past, and so you just need to treat this as a cash outflow. Cash inflows minus cash outflows. It's just in parentheses to show you that it's a cash outflow. Okay? 25,562 is my net present value. Should we take the investment? Yes, we should, simply just based upon this. Okay? So let's talk quickly about internal rate of return at a very high level, and then in the next lecture video, I'm going to talk about how to actually calculate internal rate of return. So internal rate of return is an alternative to net present value. It does take into account the time value of money. The internal rate of return, we can think of that as how much we're earning on the investment, but more specifically, the internal rate of return is the rate of return that gives us a 0 net present value. That is, it equates the present value of cash inflows to the present value of cash outflows. That is the strict interpretation of the internal rate of return. But we can infer, or we can use the internal rate of return as saying, this is how much we're earning on the investment. Then we can compare how much we're earning on the investment to our required rate of return Thank you.